Hi, my name is Travis Jones. I'm with Keller Williams Realty here in Naples, Florida. I provide real estate services to everybody here in Southwest Florida. And today, we're going to talk all about FHA loans. And I brought a special guest with us today. His name is David Trawick from Dockside Mortgage. So now, talking about FHA loans, what is an FHA loan?
FHA loan was created by the Federal Housing Administration, FHA, right? It was created many, many years ago, and it was really to assist a lot of first-time home buyers, okay? The traditional way of buying a house many years ago was, save up 20%, and then you put that down, and then, you get a traditional loan, right?
I remember that.
But if you look at today's home prices, 20% can be a lot of money. Okay, I'll give you an example. If you're looking at a $400,000 home, that's saying, okay, you need to have $80,000 as down payment, right?
That's crazy for the first-time home buyer.
That's a lot of money.
Yeah.
So FHA stepped in a while back and said, listen, we need to help out first-time home buyers. Maybe it's a young couple, maybe it's somebody who's buying their home for the very first time. It doesn't matter, regardless of age. But they want to make home ownership something possible for everyone, not just those who can save $80,000 or $60,000 or whatever that number is. Okay? Exactly. And who would be eligible for an FHA loan? Just about anyone, really. Like I said, it was geared towards first-time home buyers. So usually when you think first-time home buyers, you think like maybe a young couple just getting started or whatever. But no, I've got people that are in their 60s that are maybe buying their first home ever. People coming from up north, for example, that are moving here to Florida, and they've always rented up north. Because New York City is expensive, for example, right? Or New Jersey or whatever. And so now they come down here and they're like, okay, this is a little bit more affordable to them. So this would be their first home, okay? Now, keep in mind, first-time home buyer, you can actually have owned a home in the past. It's just you couldn't have owned a home within the last 3 years. So if you had a house and you sold it, say, in 2017, for example, and you've been renting ever since, and now you're ready to buy a house, you're a first-time home buyer all over again. So it's reusable. Absolutely, yeah.
Okay.
Now, do you have to be a first-time home buyer to have an FHA loan? No. It's typically geared towards first-time home buyers, but it just depends on your circumstances and what you have going on, what your goals are, and things like that. Sometimes FHA is the better way to go. It just, like I said, depends on you.
And how much do they have to put down on an FHA loan rather than a conventional loan? Okay,
that's another great question. So traditional conventional loan, right? That's Fannie Mae, Freddie Mac. That's going to be 5% down. Okay.
Okay.
FHA 3.5% down. Okay.
Dramatic difference.
That's a pretty big number. An easier pill to swallow versus I need 20% down, right?
Right.
So it's most people can come up with that. And then I even have programs that are like what we call down payment assistance programs that kind of piggyback onto an FHA loan that we can talk about here in a little bit. But to help people to come up with the 3.5% down payment, to help people with or closing costs, things like that.
Okay. All right, perfect. And then when you go in and you check their credit score, how much does their credit score go down?
Another good question. So when we do what's called a hard credit check or a hard credit inquiry, typically your score will drop a little bit. Okay, it's short term though, it's about 8 to 12 points. Okay, now keep in mind when you're shopping for a loan, the borrower there has the ability to shop around. And if I were to pull your credit and okay, so let's say you have an 8 to 12 point hit, right? Well, at that point you have about a 45-day window where you could shop with 100 different mortgage lenders, and they can all pull your credit. Well, you're not going to get a hit of 8 to 12 points every single time. It's one time only, and then you have that 45-day window, and then your score doesn't drop after that. Okay. Now, after the 45 days, then it's a whole other story.
And will the score go back up if you decide not to?
It will eventually, because what's happening is you're making your payments on your car loan or your credit cards or whatever. So there's a lot of different factors that are factored into your credit score in general, right? Length of time that you have your accounts open, balances on your accounts, minimum payments, that kind of thing. So your score will eventually go back up. Yeah, it doesn't take very long in that case, especially on an 8 to 12 point hit.
And then what is different from 2008, 2009, and in today's market what loans are different and in that aspect.
So going back to 2008, yeah, that's Travis referring to the housing market crash, right? When everything just kind of went belly up. And what happened back then in the mortgage industry in general, the industry was not nowhere near as regulated as it is now. Okay, so what happened back then is lenders were loaning money out to people who weren't necessarily qualified. They weren't doing all their due diligence to make sure that they could afford to repay this loan on a house. So there were loan programs out there. We give an example. It's called stated income or stated assets, which basically means I come to you, you're the loan officer, and I say, hey, Travis, I make $100,000 a year. And you say, oh, okay. You do a couple of little quick calculations, and you're like, yeah, looks good. Here, you're approved, right? In all reality, I didn't make that. So there wasn't, you weren't diving deeper into my finances and you know, my all the different things, credit histories and all that kind of stuff, right? And that's what got us in trouble. The housing market, of course, collapsed. The bubble popped, if you will. And so now there's been a lot of regulations that have come out since then. So we are probably one of the more heavily regulated industries out there. And there's certain guidelines that we have to follow. So, for example, a conventional loan or an FHA loan, there's guidelines that we have to follow, and that clearly state, listen, minimum credit score has got to be this much. You know, debt to income ratio can be no higher than this. You know, there's got to be a little skin in the game, which is in the form of like a down payment, right? Mm-hmm. So, and they want to see that people have some money so they can put that down. They can cover their closing costs, but at the same time, we're not looking to wipe out your entire bank account, right? Because you got to have what we call reserves. You know, part of home ownership is repairs, right? Mm-hmm. Upgrades, things like that. You buy a house that isn't brand new, you may want to paint, you know, the kitchen or a bedroom or whatever, remodel something. So we want to make sure we leave you with money and don't make your house broke.
Right. So you're saying that the difference between 08 and now is that everything crashed because there wasn't these regulations that you had lenders that were actually looking. They were just looking to make some extra money, and they're just giving whoever a loan and just writing it out. Is that right?
Exactly. Yeah. My own personal experience. I bought a house in the early 2000s. I was living in California, and I remember we were going over the numbers with the loan officer at the time. I was not in the business at the time. And I just remember we went over it. I'm like, okay, all right, everything looks great. And then right before we're getting ready to leave, he says, hey, if you want, I'll give you a second loan, second mortgage on this house. And I'm like, okay, for what? You know, and he says, well, you know, maybe you want to put a new car in the driveway for your wife, or maybe buy some new furniture or something like that. And in my head, I just thought, man, this doesn't seem right. And secondly, I didn't want to pay any more money than I had to. Yeah. So I just turned them down. But that's what was happening. Is there were lenders out there because they were getting paid handsomely to give out second loans, right? So you make a commission off of one loan, but now you're making a commission off the second loan. So they were really pushing those hard and heavy all over the country, you know. And like I said, unfortunately, it got everybody in trouble.
And then they're not allowed doing that no more. No. It's way more regulated.
Yes.
Perfect.
I know sometimes it's frustrating for my borrowers when I go back to them and I say, no, we can't do this or we can't do that. And they're like, well, how come? I make this money or I do this. I'm like, well, listen, the ratios don't work out or the numbers don't work out. And they don't quite understand. So I have to just really kind of sit down with them and explain rules and regulations and even show them sometimes, like here it is, straight from, Fannie Mae's selling guide or Freddie Mac or whatever. And then it kind of clicks. And once you explain that to the borrower, mm-hmm. they get it, and really it's done, as much as they don't like it, it's done to protect them, right? Because I don't want to write a loan for you and then 12 months, 18 months, 24 months down the road, you're in trouble. You're mm-hmm. in financial trouble with your mortgage, because contrary to popular belief, lenders are not in the foreclosure business. We don't want to take houses back. That's not what lenders want to do. Lenders want you to have your loan long term, make your payments, they make your money off the interest, that kind of thing, right? Foreclosures are ugly, they're messy, and really it's a lose-lose for everyone. That's not what we want to do.
Thank you for watching FHA Financing Part 1. Make sure you subscribe down below and be on the lookout for FHA Financing Part 2.